Welcome back. Let's talk about some August real estate news. There's been a lot of talk about inflation lately. In a basic sense, inflation is an increase in the prices of goods and services that we pay for. We should pay attention to this as it represents how much more you'll be spending on everyday items. It also helps to know how policymakers like the Fed view inflation. Tens of thousands of items, several categories are tracked by the U.S. Department of Labor. The prices of these items is considered then each month, and economists and statisticians look for trends in the data. If they see the CPI rising, it's an indication that inflation is on the rise. Core inflation, the other one, is only slightly different. You probably already know just from paying for these things yourself, the prices of food and gasoline often rise and decrease and are all over the place, much more than other items. So for core inflation, food and gas prices can also be affected greatly by other things other than inflation. For the core inflation numbers, these are excluded from the price comparisons month to month. So the core CPI does not have food and gasoline and other energy like electricity and natural gas included in it because those can change much more. The Federal Reserve considers the effects of inflation when it sets the benchmark interest rate and makes monetary and economic policy, probably now more than ever. So members of the Fed consider core inflation, the second one, the one without food and gasoline, more frequently, and they're more likely to consider that when they meet next week to raise interest rates.
That's great information, Chris. I'm going to step in here to further break down why inflation matters to regular folks like us. Inflation is when the cost of goods and services in an economy increases. In English, this means that if it took $100 to buy the 15 things on your shopping list a year ago, and this year it takes $110 to buy the exact same items, you've just seen 10% inflation. Being able to track and understand these trends are key to being able to actually do something about it. The one used most often in the news is typically CPI, what's known as the Consumer Price Index. The CPI is defined by the Bureau of Labor Statistics as the measure of the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. These figures are calculated by closely monitoring a rotating sample of American consumer spending habits over a 2 to 4 week period. Think of our example of a shopping basket. This is then compared over the timeline of the year and then month to month to generate the CPI figures that you hear about in the news. Since the CPI is meant to reflect what Americans really spend their day-to-day money on, we trust it as an indicator of inflation and deflation in various markets, changing of dollar figures for government programs, and purchasing power of the US dollar. Inflation is an inevitable element of modern economic growth. Governments as a whole across the world shoulder the responsibility within their respective countries and regions to enact policies and protocols to combat inflation. This can include many programs, including tariffs, minimizing the printing of money, increasing federal interest rates, and more. The latter of those is the main ammunition for the U.S. government's fight against inflation and the biggest movement motivator of the mortgage market today. The Federal Reserve controls the money supply and policy in the United States. This means they have the power to issue currency via lending to major national banks. The banks use this money to make more loans and financing arrangements for us as consumers. The Fed has been increasing the interest rate on the money they lend to our banks. This is meant to drive down spending, slow down markets, reduce the amount of loans being taken out, and in turn, slow down inflation. The Federal Reserve's increasing of rates also directly affects the mortgage bond market and increases the mortgage rates, which residential consumers are able to lock in. Have no fear though, these rates are only temporary. Rates will come back down as the CPI evens out or even deflates. Over the past 20 years of lending, the market rarely goes above the rates that we see today. So as we reach these highs, they only signal a future correction back to the norm of lending. Fortunately, these rates have caused house prices to go down to more reasonable levels. So while they are at these figures and knowing that rates will go down, we are actually still encouraging buyers to be active. Thank you everyone for your time today in the Consumer Corner. Keep shopping, y'all. And now back to you, Chris.
So each month, the U.S. Department of Labor publishes these numbers for the previous month. This month is particularly important because the Fed meets next week. This month, economists had predicted that inflation would improve slightly. Instead, all those measures came in worse than anticipated, which has put the financial markets in a bit of a spin. But in July, CPI actually increased by 0.1% instead of get better. Now, 0.1% is really not that much, but it is significant because it's going the opposite direction of where it should be going, particularly when economists have claimed that inflation has already peaked. This worries investors that maybe it hasn't peaked just yet. The core inflation numbers, the ones without the food and gas, increased more significantly by 0.6% instead of the 0.1%. Even though consumers got some relief this month from a 10.6% decline in gasoline prices, they still had to dig deeper to pay for food, rent, healthcare, electricity, and natural gas. These numbers are a headache for the Fed as well as for the Biden administration. Fed officials will gather next Tuesday and Wednesday for their regular policy meeting and will thus decide how much further they're going to raise their benchmark interest rate. It's currently projected that they will raise the rate by somewhere between 50 basis points, so 0.5%, and a full 100 basis points, 1%. Most financial markets have priced in a 75 basis point or 0.75 increase, which is right in the middle of the road. We'll have to wait and find out. In other news, foreclosures have reached pre-pandemic levels nationwide, which is actually good for buyers. Foreclosures entering the market allows buyers to have more selection when they view houses and less competition. This is likely an important piece of why home prices are actually slowing. The numbers are significant. Lenders repossessing 3,938 U.S. properties through completed foreclosures in August, up 28% from just 1 month ago and up almost 60% from last year. Illinois, Delaware, and South Carolina had the highest foreclosure rates. In employment news, employment conditions are looking positive, with U.S. companies adding 315,000 jobs in August. However, the overall unemployment rate actually inched up to 3.7%. That's not completely a bad thing. That's still a very good unemployment rate. And economists argue that unemployment will have to go up in order to get inflation completely under control. In fact, Mike Frantantoni, chief economist of the Mortgage Bankers Association, said the increase in unemployment rate largely reflects more workers entering the workforce. The labor force participation rate remains 1% below pre-pandemic levels, but the increase is positive as labor supply constraints have impacted several segments of the economy. He adds, wage growth is still strong, with average hourly earnings up 5.2% compared to a year ago. Meanwhile, Fannie Mae foresaw a housing market tumbling down to a modest recession. Ricky Goyette with Fannie Mae's Economic and Strategic Research Group said, the housing market continues to slow rapidly. We currently forecast a modest recession to occur in early 2023. Further, we expect continued home price growth deceleration over the coming quarters. Note that he mentioned home price growth deceleration. This does not mean market crash, housing crash, or an economic depression. It means that overall, home prices will just continue to go up, but at a slower and more natural pace. CoreLogic is a data company which focuses on the real estate market. They issue a monthly report called a home price index, which offers predictions like home price forecast and market condition indicators. The data incorporates more than 40 years of repeat sales transactions for analyzing home price trends. They found that home prices nationwide, including distressed sales, increased year over year by 15.8% in July 2022 compared with July 2021. However, on a month-over-month basis, home prices actually declined by 0.3% in July compared with just this June. The home price index forecast indicates that home values will more than likely return to seeing overall increases, with an expected increase of 0.3% over the next month and a value increase of 3.8% by this time next year. As 30-year fixed mortgages have hovered around 6% this summer, some prospective homebuyers pulled back, helping ease overheated and unsustainable price growth. Does this mean there's a housing crash? No, not even a little. Nationally, home prices have increased, as we mentioned, 15.8% in the last year. In fact, not one state posted an annual decline in home prices since this time last year. If prices are going down, which they are in some cases due to various factors, but they're still significantly higher, 15.8%, than this time last year, and they were higher than the year before, and the year before that, there's no crash. This brings us full circle to the home price growth deceleration we mentioned earlier. We're going to still see home prices go up. It just won't be as steep. It'll be more of a natural slope. I hope you've learned something. Join us next time.